Good evening, everyone. Welcome to the Business Influencer magazine at our first webinar of 2021. Thank you to all of you. There's 100 of you, believe it or not, who've taken out time this evening to attend. And for those, I understand there's some in the States, good morning. To those in India, good evening. And I know it'll be the good morning by the time you switch off. My name is Nachural. I'm the co-founder of the Nachural Group. We host events aimed at entrepreneurs and SMEs. So we do the Signature Awards in Birmingham and London and the Nachural events in Wolverhampton and Leicester. I'm also the co-publisher of the Business Influencer magazine. And we should be launching our podcast featuring Dinesh. I know he's actually coming in as well. He's actually on one of the people viewing. So we'll send you an email about that. Now, 2020 has been tough. There's a lot of uncertainty around the economy and the business. So we'll be holding these seminars on a monthly basis, and we'll be discussing topical issues around business. So there's certain issues you want to discuss or we're happy to cover for you. And we're happy to bring some brilliant panelists, some of who you're going to hear today. So in the second week of January 2021, we have a president who's been impeached twice, but the markets remain resolute. Cities are in turmoil, and we're increasingly turning to digital. It's been a period of many winners and losers. We've got used to phrases like furlough. Jonathan Dudley, who's one of our panelists, said the only time he'd heard of the word furlough was when he came to racing. You are all on, we've all heard the word, you're on mute. We've heard tiers 2, 3, and 4. We had to get used to the word unprecedented. And of course, the buzzword, which we'll talk about later, is pivot. So we thought, sounds like a great time, January, to have a chat about what's happened in the past and what the future looks like. So just some house rules before we get into it. Because the large number of attendees, you can only see the panelists, so you can't see anybody else listening in. If you want to send a question, please do so on the question and answer function. It's there, it'll come straight to us. Stuart here will pass me the message on. If you want to leave a message for any of the panelists, you can do so in the chat function and we will happily pass it on to them. Now, normally we'd start with some house rules. We'd normally start with mobile phones. Quite frankly, you can do whatever you want with them. I won't be telling you where the toilets are. You can, what to do. And we're not planning an alarm drill. So if you hear something, I think you have a problem you need to sort out. Nothing to do with us. Right, now that's taken a couple of minutes. We've got about 50 odd minutes to go. So let me introduce our panelists. If I can first start with Jonathan Dudley, please. Jonathan, 30 seconds or so to tell us who you are and what you do.
Hi, my name's Jonathan Dudley. I'm a chartered accountant. That makes me sound like an alcoholic, but I'm a chartered accountant. I specialise in advising family-owned and managed businesses and manufacturing businesses. I also represent the special interest group for the Institute of Chartered Accountants in England and Wales in the manufacturing sector.
Thank you, Jonathan. If I can move on to James Sage from FBC Manby Bowdler.
Thank you, Ninda. I'm James Sage. I'm partner and lead partner for what we term our corporate department at FBC Manby Bowdler, which is a full service legal firm. Just like Jonathan, my practice tends to act for owner managed businesses throughout our region, but also some international clients and obviously national clients across the full range of sectors. But bearing in mind where we are, there's a lot of agriculture and there's been a lot of manufacturing over the years.
Thank you. And finally, Nicholas Jones from Investec Wealth and Investment. Nick.
Yeah, hi, thanks, Linda. Yeah, Nick Jones. I head up Investec Wealth and Investment in the Midlands, joined by a couple of colleagues today, Martin and Michael. We manage personal portfolios for clients across what we refer to as general investment accounts, but encompassing personal pensions, SIPs, ISAs, etc. We operate from 15 offices across the UK, manage about 36 billion of assets for our clients, and our role really is to help our clients achieve their financial goals and to work with them throughout a long period of time, you know, multi-generational situations that we look after. So that's really us in a nutshell, just as a quick snapshot. But back to you, Ninda.
Thank you very much. Okay, so let's crack away. There's a saying that if you study the past, you can learn a lot about the future. So if I can turn to Martin Lord from Investec Wealth Investment, give us a few minutes on how we can assess the events of the last 9 months or sort of the last 12 months. Martin, over to you.
Linda, thank you. 2020, well, whilst it was a terrible year for most, some economies recovered and at the year end actually surpassed levels at the start of the year. China, for example. Yet the year still produced positive returns in many stock markets for sterling investors. The lesson that we learned from that is Wall Street is not Main Street. Yes, the shock and awe of the global pandemic hit stock markets hard in February and in March as COVID spread out in China. There was a clamour for raising cash. Like a sailor looking for any port in a storm, sellers found fewer buyers until prices actually hit distressed levels. At one stage, perceived safe haven assets like gold or government bonds were experiencing falling prices and irrational selling, but at least there were buyers of such assets. What I'm going to then say is about the reassuring measures put in place by central banks and governments, whether it was QE, reducing base rates, bounce back loans, furloughs, benefit payments. These did provide liquidity and assistance to companies and individuals, the man or woman on the street, rather than just the banks as per 2008. Crises can overreact to events, and rational investors were then selectively prepared to look beyond the immediate impact of COVID and lockdowns and return to buying equities and financing cash calls by companies. So in 2020, for equities, the UK market, it was down about 13%, USA up 14%, Nasdaq, for that read technology, that was up 40%, Europe was up over 8%, Japan and emerging markets up over 10% for sterling investors. So whilst one looks at the economy, there was a V-shaped recovery for investors ahead of that economic recovery, and we could achieve positive returns for our clients' portfolios. But why was the UK down, not up? Another lesson, stock markets do not like uncertainty. And here in the UK, there were additional factors as we waited for the outcome of the Brexit agreement right up to Christmas Eve. And when you, like us at Investec, have the flexibility to invest globally, you look for the obvious winners, whether in technology, logistics, healthcare, biotech. Many of these were found outside of the UK. Even if you put money into bond investments, bond market investors benefited from the policy responses of lower interest rates and QE with bond buying by central banks. So even within bonds last year, there were positive returns of between 5 and 10% for conventional bonds. Inflation wasn't an issue, and index-linked bonds also provided positive returns. So the lesson there is if you can keep your head in moments of crisis, there are good investment opportunities. Investec investment process is a robust one. We took some money out of risk assets in February after strong returns in 2019, but added back in March and early April after seeing investment opportunities in bond markets and US equities. After the bounce back in markets post-April, our assessment was that overseas markets would do better than here at home, and we reduced our appetite for UK companies. This proved to be the case, led by technology, which I mentioned earlier, and that particularly favoured the US. The discipline, however, is to keep re-evaluating, as Ninda said, history, what can it teach us? Re-evaluate what you hold and at what price. For the last 5 or more years, the US equity market has trounced most other markets, and as we look ahead, to not believe that what has gone before will continue for the next 5 years. So, to conclude, stock markets are forward-looking, hence the positive investment returns in 2020, but there are many lessons to learn from history, and I'll finish with this one. It's cheaper to learn from the mistakes of others than your own mistakes. Back to you, Ninda.
Just had a really interesting question come in. Now, normally we know when there's troubled times, people invest in different asset classes, and generally speaking, when the markets are down, people invest in gold. But we've seen a surge, and it's a great question from Stephen Goldstein, who says, and I know we're going to talk about the future later, but does that explain why people have invested in Bitcoin? Do we have an answer for that, Martin? Is that pure speculation and we should stay well clear?
Okay, first of all, if you come to someone like Investec, the FCA does not think Bitcoin is suitable for retail investors. So let's start with that. We're not going to be advising our clients to go and buy Bitcoin. It's not regulated. And as we saw previously, we've had situations where some of the, and I'm going to call it the savings banks, where it's hidden within in the vaults, they've been raided. And how do you prove that's your money? How do you get it back? And if I said, I've got a Bitcoin here in my hand, so what's it worth and what's it valued upon, and I do that, because you can't see the Bitcoin, how do you tell me what the value of that's worth? So yes, it's gone way up, particularly with Bitcoin limited supply, but likewise, we've seen it come down rapidly as well. So for the average retail investor, if you want to take a gamble, go to the horse races. I wouldn't choose Bitcoin. If you want to invest, carry on listening.
Thanks, Martin. Jonathan, you a bit like James, but if I turn to you first, Jonathan, what are your thoughts on the last 9 months, 12 months? What are your thoughts?
Well, to be honest, I unfortunately, I've got a lot of grey hairs that I've got left. Most of it is on my chin these days, not on my head. But I've got to say the last 9 months have probably been the most challenging, interesting, scary few months of my professional life, which spans back right. I was only thinking the other day, I started training back in 1982 when I managed to avoid getting on HMS Hermes to go to the Falklands. And what have I learned from that? Well, and as an accountant, it's quite significant that I make this point. First of all, don't wait for perfect. That's the first thing I've learned. As accountants, we're very, very keen on precision and getting it right and getting ready to do something. The one thing that I learned to chuck out the window very quickly is to be able to react quickly, to advise quickly, and adjust and correct where things changed quickly, because the pace of movement since the middle of March to now has been phenomenal. We'll talk later on about, there's supposed to be a budget in March. I still question that, because we've got Sunak's now been in number 11 for the longest period of time without having a budget. But in a way, at one point, we were having almost like a weekly budget off him, because he was just changing things all the while. Ninda, very quickly, I created something called a funding flow chart, which, if anyone wants that, that's available on the Crowe website. We're now up to version 21 of the funding flow chart. That's since mid-March last year. And we kept changing it, we kept changing it, and it will change again. So agility is vital. I'm going to use that word, pivoting, changing the way you do things is vital. And the most important thing from a human side is make sure you keep communicating, and then communicate again. And just keep refreshing what you're doing. It's no longer going to be acceptable in the era we're going into, which to me, I think is going to be a big change. It's no longer going to be acceptable to do something because that's always the way you've done it before, and it's been successful before. We've never had a global pandemic in business history before. The last time we had a global pandemic, it was the Black Death. And Samuel Pepys was writing a diary. That's the best thing I can actually do as a scene setter.
Thanks, Jonathan. And James?
Yeah, well, sort of looking internally and externally as a firm, March 2020 was an extremely busy time. I think for similar reasons as to what we have now. I think business owners were a little concerned as to what might happen in as far as the budget and tax was concerned. And so a lot of our clients were either taking the opportunity to acquire or taking the opportunity to cash in and sell. So the first quarter of 2020 was very busy. We then obviously, the pandemic hit, and none of us knew what was going to happen. But as I suppose, a typical regional law firm, you won't be surprised to hear that certain areas of our work have continued to be very busy, and others haven't. The areas which I think probably came as a surprise at the outset, but no longer a surprise, are residential conveyancing due to the stamp duty holiday. Private clients, where people obviously not only concerned about health issues, but also perhaps with time to look at things to say, well, actually, we need to get things resolved, look at tax planning, estate planning, but also corporate. I didn't know what was going to happen as far as transactional work was concerned once the pandemic hit. Out of 10 transactions that were going forward, you didn't know whether 8 were going to go off or all were going to go off. Actually, it seems to me, from our experience and talking to other providers similar to us and working with firms such as Jonathan's, corporate work has been very busy. And perhaps for those reasons, perhaps because either people are concerned about what is going to happen and either see an opportunity to build their business, or actually cash their chips in. So,
and James, did you find what Jonathan said, that we were having announcements from the Treasury every couple of weeks, particularly around furlough? Did you find that most of your clients were panicking around furlough, paperwork, all the employee-related issues?
The employment teams, spent those months on the phone and advising, as Jonathan said, changes daily. So yes, there was a lot of advice there. There was also, and I think this is still the case, there's also a lot of businesses who are sitting on quite a bit of cash because of the assistance that they've had, and the fact is that some of them have battened down the hatches. Some of them have done very, very well. Obviously, each sector is very different, but some of them are sitting on a lot of cash and are now perhaps thinking about what they can do with it.
So moving on and taking the cash bit. So Jonathan, if I can come to you about the forthcoming March budget, what do you think business owners and entrepreneurs should be planning for, if there is one?
Okay. I've put some notes here, if I can refer to them. I apologise for that. I've got a couple of bankers and outsiders. Martin, I haven't got any Bitcoin, and I'm not a betting man, so forgive me. And you've got to follow what the government have signalled, and I've followed quite carefully what Sunak has said, and obviously he's changed his mind. I mean, I think a lot of people on the call are still grimacing over the fact that by now they'd be looking forward at the end of the month to getting some CJRS bonus. Well, that went out the window one lunchtime, didn't it? But one thing that I think is a banker is the fact that Sunak announced, when he introduced the self-employed assistance, the self-employed version of CJRS, which came after the employed version, he signalled then that the taxation of the self-employed would need levelling up. That's the big phrase. And then, of course, very recently, there's been lots of signalling going on about the possibility of providing coronavirus support to people in small business who pay themselves fundamentally through dividends. That's something they've avoided like the plague, because the Treasury have lost case after case on the matter. But actually, that is now coming to the fore. And I think the reason that's coming to the fore is it gives him a golden opportunity in the budget to bring the amount of tax overall you pay on dividends to be aligned to that of bonuses. Now, do I want that to happen? No. Do I think it will happen? I think it's highly likely. And in the same way as we were thought it would be a possibility last year, I think it's a bigger possibility now this year. He's saying he's not going to raise taxes because now is not the right time. This is an excuse of doing that, but by levelling up and being fair, and at the same time providing COVID assistance along the way. So I think that's a real possibility. So there's a big planning point there that if you've got, as James said, some businesses really do have some funds sitting there. Now is the time, if you do have cash, to pay yourself a dividend, even if you're not taking it out of the business. Pay yourself a dividend. Know that you're going to have to pay some tax round about next January, but put the money in a tax paid regime in your own hands. The second thing, and this is also generating, and I know both I and James are very busy at the moment with corporate transactions. Loads of businesses, there's loads of, I said to you, there's a lot of American money come in around about the time of the results of the election. That was version 1 of the results of the election. I think we're up to about version 6 now. In the USA, there's lots of US money coming in. There's a lot of people cashing their chips in, and that's because there's a big fear that entrepreneurs' relief could be reformed. If it's reformed, it could even be for when the Chancellor sits down. As opposed to leaving it till April, one would hope not. And indeed, capital gains tax. Capital gains tax is a quite generous tax. You get a big relief as an individual between husband and wife. You can make a lot of money in a year without paying any tax at all. So for a sort of an additional rate or a marginal rate taxpayer to make a capital gain is really attractive. And I think he said that he's not going to put taxes up, and he doesn't want to increase the basic rate. Now he's at the right time. And I put down this buzz phrase, I think he will make changes to taxes that don't affect the masses. Because if he does any of that, actually, 1 or 2 people on this call will be, but with deference to the ladies, I come from the black country, so I use a black country term. There'll be 1 or 2 people on this call with some of the changes I've said there will be roundly pissed off. But unfortunately, there ain't enough of us to actually be worried about from a voting or a political point of view. And at the end of the day, he has got to start paying for some of this. So I think those are bankers. Outsiders, well, one thing, I've got a proposal in which I've put in on behalf of the Institute to convert some of the coronavirus debt. That's the extended lending on tax, and also C-bills loans, bounce back loans, and what have you. At some point, if you can do some good behavior, make some further investment, actually look to export, look to reshore. I actually think that there ought to be incentives in the UK to do that. Now, if you did that and reduce the COVID debt from a point of view of the Treasury, it reduces their exposure, because at the last count, the amount of money that the Treasury has got out supporting COVID-related debt, that's just C-bills, CLE bills and bounce back loans, was edging nearer and nearer to, wait for it, £70 billion, and it's still open. So that's a lot of money to put on risk. So I think, I would love to see that, and I've done a paper to it. If it goes through, it'd be lovely to see that go through, because I think that's rewarding good corporate behaviour. And then the last one, which is just, here's an absolute killer for you. We need to get retail off and running again. When things open up again, we need people buying. There's, the team from Investec will say there's never been so many people with so much cash on one side. We need people spending that, and a good way to do that and now we're free from the shackles of Europe, would be to actually make a general VAT rate cut. Now, you might say that's going to cost billions, but actually, if people are spending more money, you could get that back quite quickly. So you might just see him tinkering around in certain edges and cutting some of that VAT rate for 20% to actually get us back up the high street.
Thanks, Jonathan. And James, before I move to Nick Jones, anything to add to that?
No, I think as Jonathan indicated, you know, we've been busy for the last 18 months, and I can't see it changing because of the concern people have about the capital gains tax. That's
that's fine. And Nick, so
yeah,
budget.
Linda, budget. I mean, you know, Jonathan has covered that in great detail about specific changes. I mean, one of the things that we're thinking about and talking to our clients about are the potential changes to the CGT rates, capital gains tax rates, and potentially bringing those in line with income tax rates. As Jonathan said, it's a bit of a banker, really. So it's how you use that, and we always work with our clients year in, year out to try to maximise the allowances, but also to work with clients anything that's external to us. Any capital losses that have been created that we can carry forward or we can use, or that they may have external to portfolios that we can try to use, and the creation of the joint portfolios to use joint allowances. Perhaps with CGT becoming coming to a higher rate, then you've got to look at other elements and picking up again on what Jonathan said, you know, businesses with cash in the business, considering how you use that as a business owner in terms of pension funding. Just by way of an example, we worked with a client recently where they were drawing a disproportionately high amount out of their business, a higher drawdown, paying unnecessary income tax, and their margin rate at 60%. Well, in conversation with us, we've talked them through, we've reduced the drawdown and they're reallocating the capital that's in the business to maximise the pension contribution. And so that then helps them also achieve part of their plan where they want to be able to pass on some of their wealth generationally, pass that down to the children by allocating the money within the pension. So there are different ways of doing this, but it's really, really important to be able to look as an individual investor at maximising all of your allowances. You know, as I said to somebody the other day, you know, you go to the dentist once a year. Well, why wouldn't you at least review all your finances annually? You know, it's really important to have a bit of a financial audit and talk this through. And I think more interestingly that the people that we helped during the course of 2020 on that situation, they already had advisors. They'd come to us really just for a second opinion. But through our conversations and our recommendations, we were then appointed as the advisor and the investment manager going forward. So there are lots of different ways where you can bring this together and work through the situation that may come up. But as Jonathan said, whether we actually have the budget, and I entirely agree with you about changes will be made that will not affect the wider population, the wider situation, wider masses, if that's the right word.
I think you are right, Nick. I meet a lot of entrepreneurs who are very good at running their business, but don't think of the bigger picture. And I think you're absolutely right there. So one of the things, I know I sort of hinted at earlier, we keep getting encouraged to think about diversification and not rely on one market or one product. Jonathan, any thoughts around whether people should diversify? Should they be looking to diversify their product offering or their business? What do you think, Jonathan?
I've seen that work extremely well, and I've seen it work spectacularly badly. And it seems to generally go one way or the other. There's no spectrum here. It's almost like an on-off switch. I think if it's very important now more than ever to actually make sure that whatever your business is going to be in the future, that you can see and you can box off competitive advantage in what you do. You mustn't do something just because everybody else is doing it, because that could be just joining the rest of the lemmings leaping over the edge of the cliff. So when people talk to me about diversification, the first thing I need to say is, well, who else is in the market and how can you beat them? That would be the first thing. And then the second piece of advice I would say is know what you're doing, or get into bed with somebody that does know what they're doing, and you're being the money man and providing it, and obviously get the advice of the likes of James along the way. I've seen so many horror stories where people have sort of said, oh, well, you know, my local pub's struggling. I'm going to go and buy my local pub. And these guys, you know, they can be captains of industry, you know, at the risk of touching something a little delicate, I suppose, particularly for Ninda and I, you know, how do you turn a big fortune into a small fortune? Go and buy a football club. You know, just because you've been successful in one area of business does not mean that you will be successful in another area. The key is can you deliver competitive advantage? If you can't, stick to what you're doing. And if you can't get competitive advantage in what you're doing, then you still need to keep looking again. But I wouldn't be diversifying unless you can see that competitive advantage.
James?
Yeah. I mean, just building on what Jonathan said, where I've seen it, and again, it's when clients have been concerned about source of supply, for example. So one of their suppliers is just muddling along. You know, in these times, it's situations where people have been, you know, perhaps since 2008, just struggling along with their businesses, and the owners have got to the stage where this is the last straw. This pandemic is the last straw for them. Some people are just shutting up shop. I think I read that the number of members' voluntary liquidations is, you know, at an all-time high or has increased because of that. People have had enough. So we've had clients who've said, well, I'm worried about this particular supplier, so I'm going to invest, or I'm actually going to take over the supplier to protect the supply chain. Now that's an area, as Jonathan indicated, really, you either need to get involved or you retain the people to run it for you. But that is a type of diversification that I've seen, and one that, you know, I think we'll probably see more of over the next few years.
Thanks, James. We've had a couple of questions in. We'll try and tackle them at the end if we've got time. One was from Steve Parker about, and I might come back to you on this, what business would you start today? If we have time, we'll try and pick that up. Someone's mentioned 5G. I sit on the West Midlands 5G board. That's a totally big subject by itself. So forgive me, I don't think we'll have a chance to tackle that today. But carrying on with the diversification strategy, every in sort of IFA I've met always talks about making sure you have a diversified portfolio. Martin, do you stick with that in terms of what Investec look at when it comes to diversification?
I'm going to say yes. I mean, I think about eggs, insurance, and umbrellas. So I look back this very week, 1 year ago, when I was asked to present to an audience of Ninda Johell's invited guests. I was asked to look forward and give our views upon investment markets and the expected returns out of the very strong returns that we'd seen in the previous year in 2019. We, like many, had not anticipated the pandemic nature of COVID. I said I thought investment returns would be between 6 and 7%, that they were achievable. And it turned out that was correct. But it was through the sharp falls in February and March before the recovery in April, and then later with news of the vaccine in November. So we got there, but it's what happened in between. So as we're driving the car, there are times to put your foot on the brake, times to hit the accelerator when looking at those risks and returns. As road conditions change, you should adapt your own driving, and so too with managing your investments. So what a road trip. The winners we touched on are really those companies that deliver their goods and services to the lockdown consumer, or to those companies that facilitated that delivery. It could be digital platforms like we're on now with Zoom, like Microsoft Teams, or it could be physical like DHL, Amazon, or through the provision of key sectors and areas, sanitisation, healthcare, PPE. The losers, travel, hospitality, physical retail, Jonathan's mentioned, like restaurants, pubs, shops, but also hairdressers, dentists. And yes, event organisers, Ninda, weddings, awards, music concerts, lots of ancillary services, the coffee shops, they all found themselves on the wrong side of the COVID wall. So if all your time and your money has been played into one area like these, where are all your eggs? So, as with insurance, to answer the question on diversification, prepare to offload some of that risk. Diversify your wealth into other areas. At Investec Wealth Investment, we do this through different assets globally, and we can adapt quickly to new circumstances as we had to in 2020. Some of the insurance assets paid off and did not plunge as equities fell. These included hedge funds, bonds, gold, which we then used as a source of funds to buy the equities at distressed levels in March and April. We saw a V-shaped bounce back, and we were putting our foot, having bought the shares on the accelerator and picking them up at those distressed levels. When we bought them, we said we saw COVID as traumatic but temporary. We were holding investments such as commodities, pharmaceuticals, and technology, and then as it picked up, we were prepared to start putting our foot back on the brake. And yes, then we said, we could see the benefits from other areas rather than just the UK. November, the vaccine news, that meant that we could look at other sectors for earnings to recover. And it could be your hospitality sectors you start to pick out now. It could be that some of your competitors, Jonathan mentioned it, they've fallen by the wayside. So we'll then take profits from some of our winners and finance the investments in some of the depleted areas, which then brings me to the umbrella. So come and have a conversation with us. Let us show you where the most appropriate place to invest is, whilst shielding you from, excuse the pun, the rain of taxation in tax efficient wrappers. It could be ISAs, could be pensions, but this can accumulate into a significant sum for future access. What I would say now with diversification, with the low interest returns from cash or bonds, the investment case for diversification of risk capital is stronger than ever. And we at Investec believe we can help you with the appropriate advice and management. So to conclude, Linda, yes, diversification is important, and it's not a case of all or nothing. Thank you.
Yeah, we've got a couple of really interesting questions just coming. I'll read them out. And again, I think we may struggle for time. One from Matt Jones. We've heard the term the new norm. How will that differ from the old norm? And how can we capitalize on potential differences? We know that this is a health crisis as well as a wealth and an economics crisis. And somebody whose name I can't see has said, should we be focusing on the health of the nation, and is economic health really important? I think some of the commentators have said, well, the mental well-being is bad now, but if everybody goes bust and everybody becomes unemployed, God knows where the health mentality will go then. So I think it's a great question. It's something that we're probably going to be not have enough time. So moving on quickly then, Jonathan spoke about a lot of American money sloshing around. Crises always offer opportunities. We know there's people now interested because of the way the currency is working in acquisitions. So James, you're a corporate lawyer. Have you found that there's been a lot of activity now during periods of crisis where people are pressured into selling, or people now see assets they can buy at a really, really good rate?
Yeah, well, I mean, starting off, I think I read, just thinking about what we were going to chat about today. The Federation of Small Businesses has done a survey, and they've suggested that, the way things are standing, they're estimating up to 250,000 small businesses will go bump this year. That's obviously tragic, and we want to avoid that. But obviously, with things like that, it also does lead to opportunity. And I think that there are opportunities for people, as we've said, perhaps sitting on funds, thinking about diversifying to stop themselves being at, in a risky situation. Should this continue? Should something like this happen again? It all leads to people thinking about what they might do. So I think that what we've seen, as we touched on, the transactional work, there's been a lot of transactional work going on. for the reasons we mentioned, because of the tax situation, the uncertainty as to what's going to happen as far as tax is concerned, capital gains tax. People getting to the stage where their age profile is such that it's forcing them to plan, to think about actually planning for an exit. I also think in certain sectors, and we're busy in some of them, that the compliance, health and safety issues that people are becoming, they may feel overburdened by it. So I think those areas where the consolidators have been working over the last few years, such as financial services, the small independent financial advisors, such as the veterinary sector, that has actually continued. We thought that might stop. They've all still got a pot of money to go out and continue their consolidation. So we believe that will continue. I think the resilience of the UK businessman is incredible. It really is. You start at the end of each of our financial years, or a few months before the start, we look at our budgets and say, well, actually, we've got a blank piece of paper. Where's the transactional work going to come from? There's always opportunities, because the people in this country look for the opportunities. Whether they're themselves disruptors or they see something that's disrupted their market, they then go out and create opportunities. From our perspective, I think we just see that continuing. It's not going to be easy. The figure from the Federation of Small Businesses shows it's not going to be easy, but I think that there will be people that take up those opportunities and take advantage of them.
Jonathan, can you add anything onto that?
I could. Yeah, sorry, I'm not anymore. I was just I'd moved my mouse. Sorry. I think I would echo totally what James said. I think there's a lot of world weariness out there. Interesting enough, when we sat down on that should we say lockdown day, I can remember talking to my corporate finance partner, and he was really down in the dumps because he was within 48 hours of completing on 3 transactions, and every single one of those tipped over. I'm pleased to say that every single one of those completed and more before Christmas for at least what the original price was. So there is a lot of activity out there. I think going forward, there'll be a lot of world weariness. If you're talking about stuff going up and down the supply chain, I don't think that's diversification. And I think there will be people who, or certainly businesses, larger businesses, will look to build. They'll look further up their supply chain to secure their supply chain. I was talking to a guy today who was saying, well, I'll be okay, I've got a large business. I said, yes, but what about all of your suppliers?
Yeah.
How many of your suppliers turn over between 1 and 5 million? And how much debt have they taken on in the last 12 months? I said, what you should be looking at is actually, do you want to sell? And I think there will be a lot of activity where that's involved. People buying up supply chain, down supply chain. It's still dealing with stuff it's still adding value because effectively you're the biggest customer anyway. In a way, it's a kind of consolidation. And I think there will be lots of opportunity for that in the year that we're going into, because there's a hell of a lot of good businesses, good quality businesses, but with a lot of underlying debt, probably at a level that's been taken on where the business owner has been happy to do that, where the government have been happy to underlie it. But going forward, if the bank manager wants the deeds to your house, I think going forward, there's a hell of a lot of business people going to say, I ain't going to do that. I'll flog instead.
Michael from Investec, I read somewhere, thank you for that, Jonathan. I read somewhere that this is going to be a bumper year for IPOs, initial public offerings, and all the numbers are saying it really is. So do you have a take on mergers, acquisitions, and how it affects how Investec look at investing?
Yeah, thanks, Linda. Yes, with regards to M&A, I think the environment now is ripe for a real strong increase in M&A activity in both public and private markets. I think the three pivots for that, really the resolution of Brexit, getting that over the line from the public markets side of things, because what we've started to see, some instances of good quality UK businesses which have had a valuation discount applied because of Brexit, see themselves become a prey from overseas predators. It's been mentioned, but the opportunities that have come out of COVID, some businesses looking to take opportunities to expand, to diversify, and more on the private and the owner managed business side of things. There is a rush to potentially try to beat any changes in taxation that may come as the Chancellor looks to pay for the costs of the pandemic. Interestingly, yes, specifically on IPOs, what we've actually seen over the last few years is a lot more companies staying private for longer, because there's been a lot of liquidity in the private market. So companies have stayed private, but there have been some instances where we've started to see IPO activity increase. If we go back towards the end of last year, a company you might have heard of, the Hut Group, which had previously said it wasn't going to want to become a public company, had launched a public offering, which has so far been quite successful. Irrespective of the number of deals going through, what we do at Investec, and we feel it's important to work alongside accountants, solicitors, and other advisors long before sales are actually entered into. It's all about getting the house in order to maximise the opportunity available to the business owner. There's of course, the tax efficient planning during business ownership. There's actually the discussions about what does a sale, a transaction look like for that individual. And then following sale or transaction, there's the estate planning, the asset protection, the intergenerational wealth planning. So proper planning, which can be over a significant amount of time, does aim to prepare the individual for the transition away from owning a business. There's the consideration of the wealth creation event, working with planners and investors to structure tax efficiently how they're going to invest their funds, pass their wealth on, secure their wealth. And then certainly my role at Investec is constructing investment portfolios, investing that wealth, taking into account the objectives and the attitude to risk of those clients. And while I've illustrated that for business owners just in response to the audience and the question asked, it actually applies to anyone. It's all about planning the correct structure for each stage of an individual's life.
Okay, well, we're on to the final question then. If we get an opportunity, there are some questions that have come through and we'll try and tackle some of them. We've looked at how we got to where we are today, last 10 months or so. We obviously now want to project, particularly for entrepreneurs and SMEs, what does the next 12 months look like? Crikey, if we take the last 12 months, it's going to be difficult. So, Michael, let's start with you first, then I'll bring James and Jonathan in. If you're running a business, what does the next 12 months look like from a planning perspective? What should we do as business people projecting 12 months?
And I was going to touch on a few points which I'm actually covering a bit more detail in the next edition of the Business Influencer magazine, in an article that I've put together. I think first of all, if we look at the economy, obviously economies across the world have started to increase lockdowns as we've seen the rate of infections and hospitalizations increase. So of course, very short term, we are expecting that knock-on effect of activity to weigh on GDP. So in the UK, we're expecting a contraction in Q1. So that takes us into double-dip recession. But what we've got to do is not look down. We've got to look out to the horizon. The great news is that science and technology has come together, and we've had an extremely quick response to creating a vaccine. And that news in November and since November has created a bit of a shift in markets. You know, but that really does get rid of a lot of the uncertainty. And so pushing our horizon out a little bit, we're just starting to, we get a bit more positive about the vaccine rebound. Where do we see policy? Because that's a key thing, because we've had a lot of support from the government through the last 9 months. We've had a lot of support from central banks, liquidity, interest rates are low historically. Our expectations are that policy remains very supportive through this year and into next. Interest rates aren't expected to rise probably until at least 2023. We expect inflation to increase, but not to increase rapidly. Central banks have made it quite clear that their policy actually is to keep policy accommodative, and they'd be willing to let inflation run a little bit hot, as they term it. So while that's our central expectation, I think we probably should be aware that a risk would be a stronger recovery out of the pandemic, which in turn would lead to the markets to start pricing that in through higher yields, which for us, we could see that having implications for certain parts of the equity market. The recovery, as we come out of the pandemic, in our view, is consumer-led. We have seen over the last 9 months or so that generally there's been a rise in household savings. Now, I acknowledge that that has not been equal across society, but however, there is a lot of pent-up demand. We can talk about last year's winners, and that's been sort of technology and companies that have technology that have allowed businesses to continue, etc. But there's a lot of business that has been talked about earlier, mentioned, that have felt the effects of COVID: hospitality, retail, travel. There's a lot of pent-up demand there, and there's that savings wall behind it that we believe will drive the recovery out of the pandemic. And I think, for instance, I saw on the news earlier that TUI, the travel company, had noticed a sharp rise in bookings from the over 50s. People who are in line to get the vaccines are starting to already plan deployment of those funds. And so if we sort of look at that from an investment perspective, Ninda and Jonathan, earlier you've used the word pivot or pivoting, and I think we can see that in markets. The news of the vaccine has started to create that, whereby we can now look forward to businesses that can come out of COVID and survive, and that's something that we've been doing. We've been looking for identifying good businesses where we believe they had the financial strength to weather the storm, where their businesses have been impacted, get through COVID, and then come out on the other side and grow from there. With our framework of focusing on businesses to generate a decent return on capital relative to their cost of capital at a good valuation, we believe that there's plenty of businesses out there that we can invest in, which will recover from a more return to normal in the environment. And perhaps I'll make a couple of points on technology and healthcare, just in response to a couple of questions.
Michael, if you can do that quickly, because we're running out of time, if you don't mind.
Technology, I think we look for companies who are adapting and adopting the technology into their businesses. So it's not necessarily just about the headline FANGs that they get termed, but companies are taking on technology to drive their business. And I think we see healthcare as well, the need for more efficient delivery of services. It's not just about pharmaceuticals. There's a wide investment opportunity there for us.
Thanks, Michael. Fantastic. Jonathan, 30 seconds, please, on what you think is going to happen. And I'm sorry, but we're running out of time. And then, James, if I can give you 30 seconds as well. So, okay. Jonathan, 30 seconds on what you think the next 12 months look like.
I think if we're clever, we'll see the good stuff that's come during lockdown. I think there'll be some real opportunities for people that can see the opportunities of some of the changes that we've necessarily made, the bits that will stick. I mean, I've got a client of mine who's a roofing contractor, and I said, you ought to think about doing loft conversions, because I actually think, people will be building home offices. And I think they'll become a permanent thing. I don't necessarily think we'll all be carrying on working from home, but I think we will see a change of environment. People will be doing 3 days at the office, 2 days at home, what have you. There'll be a real mix match around that. I think you might see a different change in the way that vehicle fleets operate and the way that you operate motor cars and that kind of thing. I do think there's a real opportunity out there to just try and visualize how life is going to be going forward. Look at what you do and how you can add value and offer that. And I think there's real opportunities in that. Is that a good enough 30 seconds?
Thank you. And James, before I come to you, just to support what you've just said, a survey today said 49% of renters in the city of London are not looking to return. London. James, 30 seconds, please.
Yeah, I mean, just looking at it from a legal perspective, I don't think we're going to see much change for the first 6 months. I think, you know, what's happening now is going to continue. I think that the push factors that we talk about for people to look at either selling or to look at acquiring will remain in place. I do think, I mean, I'd made some notes and John's hit the nail on the head. I think, you know, remote working's here to stay. But I don't think, you know, we're still going to need offices. We're still going to need people to be in those offices for part of the week. On my side, for 2 reasons. One, how do you train? How do you train a young solicitor or an accountant or a financial advisor? You can't do it all remotely. You do need to be, you know, see them physically. They need to hear you on the phone, on a Zoom call. And the other thing is marketing. You know, the work that I've spoken about, a lot of it has been with existing clients and existing referrers. How does a new solicitor, accountant, financial advisor build up relationships with new people? That, you know, hopefully second half of the year, we'll see that start to open up again.
Thank you.
Fingers crossed.
Thank you. Right, let me just very quickly go through some questions. We can't answer most of them, but it's just what people have picked up. I've gone through Matt Jones, what he had to say. Azim Khan, I know he's from Manchester, says, I think when a company decides to pivot or diversify, it needs to make sure it complements its existing business. So my question is, when do you decide to pivot and diversify? We won't have time to answer that, but I'm sure we can pick it up in another webinar. Then I've got one which says, what's the best advice on how to plan, future-proof and protect your business from all angles? So it's like a 360. So again, we'll pick that up maybe in another seminar. Safraz Ali says, I'm finding quite a few business owners are still in the early stage of their business, are talking about buy and build and thinking they should acquire rather than organic. Again, maybe that's something we'll pick up later. So thank you for those questions. Those are just a portion of questions, and I've just had a couple of other reminders. So before we close this seminar, I'd just like to remind you, and then we're going to pick up a comment from Nick, because Nick's going to talk about our next webinar. Just to remind you that, firstly, to thank all the panelists, thank all the attendees, and all the entrepreneurs. You know, you're promoting the business. You're optimistic people. We're all sort of half full, and we need to get that optimism through. And I'll finish with a couple of comments in a minute. But maybe Nick, if I could quickly go to you and say, what are we going to be chatting about in our next webinar coming up very shortly?
Yeah, thank you, Ninda. And just to echo your comments as well, just, you know, thank you everybody for joining us, and thanks to all the people on the panel for comments, and I hope everybody's found it informative. Yeah, 25th of February, Investec are going to host a similar seminar, give you a bit more detail about our views on investment markets globally. We'll be joined by our head of research, a chap called John Wynne Evans, who really has some very, very interesting thoughts to share. And also we'll talk about some financial planning opportunities on a personal level. There's a link to go to that to register your interest, which is, Nindy, you might want to jot this down, invest.ec/market update. So invest.ec/market update. If you want to jump on there, register your interest, and then we'll come back to you with all the details and how to get on that and how to take part. So yeah, in the meantime, thanks again. Thank you, Ninda. I'll pass it back to you.
Right, last couple of comments. If you haven't subscribed, why not? Secondly, this guy, fantastic Mr. Dennis, featuring on our first ever podcast. We'll be sending you dates. It'll be this week sometime. So we'll send you some dates for the forthcoming podcast. Just to remind you, today the Daily Mail's headline was 21 million jabs ready for deployment. The economy is destined to bounce back. Listen, ladies and gentlemen, we have a great, bright future in front of us. We just need to stay safe. And normally I would say, have a safe journey home. So I will now say to you, have a safe trip to whichever room you're intending to go to. Good night, everybody from Nachural and the Business Influencer magazine. Thank you very much.